Hello and welcome. You're watching In Your Interest. I am Shweta Kothari. Here are the top stories we are tracking at this hour. Indian equity indices ended the day lower with Sensex down over 150 points. Nifty closed below 25,150. On the sectoral front, selling was seen in capital goods, power, oil and gas, realty, while buying was seen in metal, IT, telecom and media. The BSE mid-cap index was up 0.3%. Small cap index added 0.5%. Adani Group to raise between 30,000 to 40,000 crore rupees from retail HNI investors over the next 3 to 4 years. Move aimed at diversifying sources of funds and mitigating risk. Swiggy lags behind arch rival Zomato despite posting a strong jump in revenue. In financial year 2024, Swiggy's market share on gross order value at 43% in the food delivery industry. Zomato's 57% share in FY24 emerging as the market leader. Scores of disgruntled SEBI employees gather around market regulators' headquarters in Mumbai stage a protest. Protests erupt a day after news of a complaint letter to the Finance Ministry accusing the top leadership of fostering a toxic work culture. Prime Minister Modi is on a 2-day visit to Singapore. 4 MOUs have been exchanged between India and Singapore so far. MOUs signed for cooperation in semiconductor ecosystem, digital technologies, skill development, education and in healthcare. India's economy likely to achieve a growth of 7.2% in financial year 25 as projected earlier. The Reserve Bank of India Governor Shaktikant Das says India's economic growth slowed to 6.7% year-on-year in April to June quarter this year, below RBI's projection of 7.1%. In a series of tech layoffs, major IT firms such as Intel, IBM, Cisco lay off 27,000 employees across the globe in August of 2024. So far this year, the industry has seen over 136,000 tech professionals being laid off across 422 companies. Hurun Rich List of 2024 is out. According to the report, founders of quick commerce platform Kaivalya Vora and Adit Palicha emerge as the youngest billionaires in India. Direct employment related to exports in India falls from a peak of 9.5% of the total domestic employment in 2012 to 6.5% in 2020. The World Bank highlights in its latest India Development Report. And you're watching all those stories here on News9 Live. But this is a Teachers' Day special. Teachers are vastly celebrated and honoured across the world for showing the way to people who follow them. In India, we celebrate Teachers' Day today on 5th of September, commemorating the birth anniversary of Dr. Sarvapalli Radhakrishnan, former President of India. On the show today, we hope to go back to the learnings of the stalwarts in the stock markets who have been a guiding light for millions of investors in India. While the Indian stock market continues to be resilient, outperforming its global peers, what are the lessons we can draw from markets and mavericks to win over risk and sentiment-driven equities, and how to make the most of the opportunities to create wealth? We're discussing all of that. On the show today is Andrew Holland, CEO, Avendes Capital, Nishchal Maheshwari, market expert Rohit Srivastava, founder and market strategist. With me, Suyash Maheshwari. I think we'll first set the ball rolling, Suyash. This is our Teachers' Day special. We're hoping to learn from people who actually paved the way, from Warren Buffett to Rakesh Jhunjhunwala, the Indian Warren Buffett.
Right.
These people have actually shown the way for stock market, investors like you and me today.
Certainly, Shweta, and it's very interesting that you called Mr. Rakesh Jhunjhunwala an Indian Warren Buffett, but their investing styles were much more different. And I think the primary reason why their investing styles were different was because of the fact that they operated in different markets. You see, Mr. Warren Buffett, he made his money or wealth investing in well-established large American corporations, whereas when Jhunjhunwala was coming up, his strategy centered around, leveraging on this growth potential of India, because remember, India was still an emerging market, and as a function of, operating in a high growth market, his investing style was much more flexible. You see, Mr. Jhunjhunwala, he made his wealth or a bulk of it following the same principles that are embodied by Buffett, like value investing, compounding, long-term investing. But in his early days, when he was building that initial corpus, he was very aggressive.
Okay.
He used leverage, borrowing money from the markets to amplify returns. So I think that comes from a function of where he was operating and the market that he was operating. And look at the sectors that they were working in. Mr. Buffett primarily invested in sectors like insurance, banking, consumer goods, companies which have good and strong cash flows, right? And on the contrary, Jhunjhunwala was investing in pharmaceuticals, infrastructure, retail, and these sectors were still developing in India. They also had very different public personas. You see, Jhunjhunwala is called the big bull of India for a reason. He never shied away from public appearances, and I think he was the biggest proponent of Indian market and this story that he really believed in, that India is on a cusp of an economic breakout, and I think he sold that idea well, and that's why, whereas you wouldn't hear much from Buffett. On the contrary, but at the same time, they had a lot of similarities, as you were pointing out. One is that they were long-term investors. They invested in fundamentally strong companies. They looked for value and they decided to stay in it for the long ride, right? Other thing was that they were also, proponents of compounding. They believed strongly in the power of compounding. And, just a quick anecdote on that. I remember, I was listening to Mr. Prashant Desai, who has worked very closely with Mr. Jhunjhunwala, and he said that once, Titan, his initial investment, because it is one of his biggest investments till date, Mr. Jhunjhunwala, he has passed away, but he has not sold bulk of his equity from Titan, and he invested in Titan based on the ideas that HMT is closing down. And in India, you need, in every Indian marriages, there's a tradition of, giving your son-in-law a good watch. A good watch. And if the watch doesn't function properly, or if it's not of good quality, that brings dishonor to the family.
Absolutely.
So that was the idea that Rakesh Jhunjhunwala was playing with. So a lot of similarities between the two. The principles were the same. I think where they differentiated was in their ability to take risk and the sectors that they focus on. But I think that comes from the fact that they operated in different financial markets.
All right, absolutely, operated in different financial markets. Andrew Holland is with us. Andrew, who is the stalwart you look up to? It's Teachers' Day. A very happy Teachers' Day to you and to all our panelists. I want to begin by asking, who was that one man you really looked up to when you were initially foraying into Indian markets, and what are the key lessons that you've drawn from them?
So, I mean, there's been many, people. I mean, Rakesh was someone I used to meet up with on a very regular basis when I first came to India, and I remember him talking about PSUs with me, saying, that they're unloved, and they'll probably remain unloved for some while, but at some point, the fundamentals for that sector will lead you back to the PSU. I was talking more about the oil companies at the time, and that proved to be correct. And that's where he made quite a lot of money in his early style of more trading than it was investing. But of course, once he'd built up the corpus, then to take more longer term investments, he took that with both hands. So. His style of building up a corpus through trading, the different sectors, the markets were, a little bit more kind of difficult to kind of to trade as they are today. But it was more that skill that he could utilize to get that corpus higher, and took contrarian views when the market was really just not concentrating on the kind of potential. And so I always remember fondly of our meetings in Nariman Point.
Shweta, one of the things that both these stalwarts embodied was compounding, power of compounding. And let me take this question to Nishchal. Nishal, I mean, I think that is one of the biggest shortcomings of modern day investing, that investors, especially young investors who stepped into the market post COVID, they lack conviction. You know, they don't stick around like Mr. Jhunjhunwala or Buffett would. Like, they believed in a story until, you know, there is a structural change in that story. How do you think, or do you think, is it possible for retail investors, modern day investors, to emulate the success that Buffett and Jhunjhunwala had using this power of compounding?
Evening to both of you. I think, yes, I do agree basically. I think it is not that Mr. Buffett or Mr. Jhunjhunwala have done anything differently from what regular investors in India are. So they have all started at the very start, basically from small. If you go into history, basically both of them started very small things. Though Buffett's style has been pretty different. Basically, he's always been a value investor trying to find out the undervalued stocks in the US market. In case of Jhunjhunwala, basically, Rakesh bhai, it's largely been initially trading to build up the base and thereafter basically buying the right stocks. But I think both, one thing is common among the two, basically, that they have had huge convictions, basically, and that's why they bought, whenever they found something interesting, they went whole hog into it and had almost like, if you look at it recently, Buffett had almost 40 to 50% of his money in Apple. And similarly, I believe basically Rakesh would also have something like 30 to 40% of his money in Titan. Now, I would just want to highlight, I think these convictions and all things build up over a period of time after spending decades of experience in this market. So I do not expect young investors who are just entering the market to start building convictions. I think they have to learn the lessons. They have to go through a few cycles in the market. And then if they are still there in this market, I think convictions will build. I'm saying for myself, basically, I've been in this market for 30 years, and the convictions has taken time to build. So I think if they are in the market, I think it's a good start for them to be in this market.
On break, Andrew, you know, we were talking about obviously the cyclical changes that have happened over the course of last 30 to 40 years since the Indian economy opened up. In your assessment, sir, have some of those basic core learnings being challenged and sectoral? Obviously, you know, what would be the sectors that you would invest in about 20 years ago may not be the same sectors that you're looking at investing in today. What, according to you, has really changed in Indian stock markets over the course of last 20 to 30 years? Since Indian economy opened up? And I'm also asking this question on the back of the fact that a lot of people today feel that market is extremely hot. There is over financialization of markets. In all that context, you know, tell us about where we are today. Is it better off than, of course, where we were yesterday? I think that goes without saying when it comes to growth, when it comes to avenues. But should one be varied today before making that investment?
I think you should always be wary about any investment you make. It's all about the opportunity cost of what you want to do. So we talk about equity markets today, but equally you might be saying to yourself that if you do feel that equity markets are kind of overvalued in the shorter term, and maybe that shorter term is the next 1 year or so, is there any other asset class that I can look at which might give me better returns over that period? So that's the kind of thinking you should always do. But in terms of our markets, I mean, when I first came to India in 1997, it's a long time ago. Your big stocks of those days were your Hindustan Unilevers, your fertilizer companies, and your hotel sector. Those are the big companies within the index. So of course, Reliance was still there. And then over those years, you've had the IT sector, you've had the banking sector, all kind of continue to build. You've had infrastructure, the kind of L&Ts of this world. So you've had this whole thing, but you kind of get to that peak, and then the 2008 crash can come, and that changes the whole picture again, and then you go through a different cycle of where the growth is going to come from. And where we are today is probably more IT technology led, and that's what's exciting people. But actually basic manufacturing, like electronic manufacturing sector, for example, it's still going to give you 50 to 70% growth for most of those companies participating in the sector. So it's not just your new exciting areas of technology or disruption. There's also some basic industries where you can make some good money. I mean, cement, it's continuing to do very well for most of those companies. So I think you have to look at where you think India is going to be in terms of its GDP growth over the next 2 to 3 years, and then identify those sectors which will be the big beneficiaries of that. It could be just the India consumption story. It could be part of the consumption story with exports as the global growth picks up. So there's many factors that you have to look at, but sometimes it's the simple stories, right? If you're eating in and you're getting all the food delivered from XYZ company, then you could, everyone is doing the same, then surely it's going to be good for their revenues, good for their profits, and then surely good for the share price.
Very
So some basic stuff is there as well.
Okay, so very interesting. You've got to keep an open eye for what's really ticking out there, picking up with masses. Sometimes creating wealth would really be about not just reading deep, but looking around you with a more holistic vision of what's going to last long, what are people really doing, what is that one trend that you can pick on and perhaps invest in stock markets. I think from Titan to where watches were a very important part of your life to now where people are eating out, so perhaps food delivery is going to pick up. I think the story is more about if you want to create wealth, look around you, what's really picking up, Suyash.
Exactly, Shweta, I completely agree with you on the fact that, Andrew also said something like sometimes it's about simple stories, and that's what these guys did, right? They invested in businesses, one, that they understood, so the investable universe was small. And Nisha, let me come to you on that because, we have come to know that an effective risk management tool that works in the market is diversification. But at the same time, Mr. Jhunjhunwala and Warren Buffett, they have made their money, investing in businesses that they understand and thereby keeping their investable universe small altogether. So how does a retail investor or anyone stepping into the market strike that perfect balance where, they are still invested in the businesses that they understand, and at the same time, they are not under diversified, whereas they are overexposed to certain sectors?
So I have a slightly different view here, Suyash, basically, because I think what really my experience has been in this market is if you have convictions, and convictions only make money. So over diversifying and trying to balance it out, you might as well invest into the mutual funds. If you are doing direct investment, basically, then I think not more than 10, 12 stocks in your portfolio is good enough. And you don't need to be necessarily invested in every sector. So my approach has been very, very strongly bottoms up and understanding the stock, looking at the right industry, right quality of people, and obviously the numbers and growth. So these are 3 or 4 things basically when I go and look into a stock, basically that's what I look out for.
Right.
And if it is there, basically, then definitely I go out and invest much larger because that's a way. Otherwise, if you are over diversified, you may have many winners, but it doesn't impact your portfolio.
Right. All right. And Andrew, I have a question for you. A lot of chatter about that Warren Buffett, because he's sitting on almost $300 billion in cash pile. They have made that argument that he has been sitting on this cash pile since COVID. He's not investing anywhere. Has he lost his touch? Do you think he's playing safe? He's almost 94 now. He doesn't want to hurt that legacy. Because I ask this because, a lot of these investors, young investors, they emulate the strategies of these stalwarts. Should one also, look at this current version of Warren Buffett as a person to emulate in their investing strategy?
So I think the principles of how it looks at companies, in terms of simple industries with high growth, you should always be looking at that. So I don't think that the way his investing style should be questioned. Now, whether he's sitting on so much cash because he doesn't find value is a different matter, you know, for him. And you know, maybe he's expecting something where he'll find better bargains down the road. But what I would say is this: is that, you know, when you're trying to follow someone else's style, is a couple of things, and it's very important is that, you know, when you have high conviction in a certain sector, then there are going to be certain companies within that sector which, you know, you believe are going to be, you know, the beneficiaries. So all of them will do well.
Right.
It's the one that you have the highest conviction with. So I don't think following anyone's style is going to work for you, because you can be contrarian. You could be contrarian for years. And that stock doesn't move.
Absolutely.
But I think if you follow your own principles of where you think you can make money and keep trying at that, you'll make mistakes. It's fine.
All right, and you know, before I close the show, I have to say, and I have to ask Nishchal one last question. A principle that for a very long time Rakesh Jhunjhunwala emulated is always go against the tide. Is that something that you think current investors should also look at, vouch for, follow, or do you think it's about time that you should also ride the tide?
So I think at the moment, I think you should be cautious in this market.
Okay.
And obviously valuations are there. I think a lot of people have spoken about it. What I see here is basically, I think the kind of things which we've been hearing the last week, 10 days, the kind of frenzy we are seeing in some of the IPOs.
Right.
I've seen several cycles, and these are typical signs of peaking of the cycle. Now, I'm not saying basically that there's going to be deep corrections of 30-40%, but definitely 8, 10, 15% kind of a correction, and one should definitely be watching out for that.
All right, gentlemen, thank you very much for taking time out for joining us on this classroom session on stock markets. This is, of course, our Teachers' Day special. Wish you all a very happy Teachers' Day. We continue to learn from stock market stalwarts. You follow them, not necessarily emulate all their strategies. That's the word coming in. Also, be careful. You can never be too careful when dealing in stock markets. Thank you very much for watching.